Show. I'm Neeraj Shah, and over the next 20-25 minutes, we'll talk about 2 or 3 key aspects of mutual funds. Um, in the last few weeks or months, if you will, PSUs have made a bit of a comeback, a roaring comeback, if you will, and the fortunes of some of the companies and the market caps have really taken an upswing. The question to our experts is it a good idea to invest in PSU funds? Or maybe I can frame the question this way, that why is it not a good idea to invest in PSU funds? Of course, there's a lot of talk about whether people should invest in mid and small cap funds currently, or is it better to bet on safety and therefore veer towards large caps because the markets are trading at highs and India is the most expensive market from a P multiple perspective versus the other emerging markets. So we'll try and get a sense of what is it that our guests are telling their clients to do and what is it that they themselves are doing. And of course, so many people say that they are ready to take a high risk because India is performing so well. So the next 5 years, if you want a high risk portfolio, what should be the essential components of that portfolio? We'll try and talk about that as well. Our experts today join me on the show to talk about what is it that they believe, and of course they need no introduction and they've come multiple times on the show. Sunil, Jhaveri, and Amol, Joshi. Gentlemen, both of you, thank you so much for taking the time out and being with us today.
Thank you for inviting me.
Okay, so let me first start with the moot question. A lot of people believe that they want to go ahead and still stay invested in mid caps and small caps. And some people believe that they want to take the safety of large caps. Now, while you guys may not be advising on what market cap should be chosen, but where is it that you are telling your clients to put in money currently, fresh money for the near period of time? Is it large caps? And I'm presuming in large caps, passive large caps are doing as much, or passive ETFs are doing as much as a large cap fund, or is it the mid and small cap space?
So the question is to me?
Oh, yeah. Sunil, please start.
Sure. Yeah. Thank you. So yeah, large caps actually become the anchors in any portfolio. They give you stability in a portfolio. So mid caps, yes, I would still go towards mid caps also. Large and mid cap is the space which I would recommend my investors to be in. But when we wish to get into a small cap kind of a space, one has to be extremely cognizant of the fact that it is an extremely volatile market cap bias. So if you understand 2018, if you had invested 1 crore rupees in Jan 2018, the value of Nifty small cap 100 was down to 36 lakhs as on 23rd of March 2020. And even now, after the humongous rally in small cap space also, in spite of that 1 crore is the value is somewhere around 1 crore 6 lakhs only, delivering only 1.2% return. So in the index space, yes, small caps will not really make any sense because in small caps, the fund managers will have to select the right stocks for them to pick and choose and then invest, because small caps is a sentiment driven market rather than fundamental driven markets. And small cap is a much larger space versus the large cap and the mid cap space, which is top 100 and top up to 250. So that's where the mid caps stop and then the small caps start. So those who don't understand when to exit out of small caps and those who do not have the stomach to digest volatility, I would recommend not to be in the small cap space at all. They have come with a mindset of a fixed deposit, Neeraj. All of us know that. All the investors have come with that mindset. So if they are able to deliver inflation beating fixed deposit plus kind of returns, large and mid cap is the space which they should be in, not beyond that.
Okay, fair point. Amol, can I bring you in with kind of carrying on from where Sunil has left off? Let's assume that there is so for a set of viewers or a set of people who don't have the right experience of timing the market, maybe and that answer is perfectly fine. For people who kind of are looking at the markets a bit more actively, would you still recommend that, looking at the valuations, etc., that it might be better to be in the safety of large caps, or can people also take in mid caps and small caps in particular, for generating the alpha in the portfolios.
So Neeraj, adding on to what we have already discussed on the show so far, so typical investor is constructing a portfolio not just for one financial goal, right? So somebody wants money 3 years later, 5 years later, and maybe one component is there 10, 15 years later, let's call it retirement, kind of fund. So once you have multiple financial goals that you are planning for or constructing a portfolio for, the longer term, 7 to 10 years and above, we still are, comfortable recommending mid and small cap funds. And I want to bring in one more point over here, especially if you have exposure to be taken via the SIP route. So if you have some lump sum amounts, then I agree with Sunil that we would go towards large cap or especially large and mid cap space, large and mid cap fund, the category itself. But if you are saying that I have a 7-year, I have a 10-year investment horizon, and I have money to be invested via SIPs. SIPs goes without saying, now all of us know very, very well that at the most basic, SIPs will get you the averaging in any asset class. More volatile the asset class, better is your averaging experience. So I would say mid and small cap funds, dedicated funds also, we would probably recommend for somebody who takes exposure via SIPs and has a 7 to 10 year investment horizon. That's just one aspect. And quickly bringing second aspect to it, we have always spoken of asset allocation. I think you also mentioned very briefly in this in the show earlier. But within asset allocation, don't just think that asset allocation is between equity, debt, gold, and international equities or alternate assets. Asset allocation has to be there within equity segment also. So I would say that if you put gun to my head and if you ask me, please give me an asset allocation within equity, I would say 60% into large caps or flexi caps, and remaining 40%, 20-25% each into mid and small caps with a 7-year plus investment horizon is how I would construct a portfolio today.
This is also for people who may not be completely well initiated in the markets, Amol. You think 7 years will take care of that?
Yes, this will take care of that. And I will tell you why I say that. I repeat, no harm in repeating. SIPs will get you averaging. Now, we all know that the journey will always be, the 7 years is not one way upward slanting line. Not the experience what market will deliver to us. But the averaging aspect, if you continue your SIPs for 7 years duration, I think there is a case to look towards mid and small cap funds.
Okay, maybe we'll actually talk about this in detail when I come to the third point. But let me quickly bring in the second point first, because I'm more interested in understanding the portfolio piece for a high risk investor, because a bunch of people are writing to us about that. So first, before we get to that though, Sunil, come in on PSU funds, right? Now the point is, for long they've been shunned. I think the most obvious answer at any given point of time in the last 10 years would have been, no, don't look at PSU stocks or PSU funds. But I think there's a case being made out here for people who say that why not PSUs? Because there are a bunch of those which are now starting to do really well, and with reason. In that these are not just a fluff in a season kind of moves. There are some serious fundamental reasons for some of the PSU names which are making some serious moves and making new life highs. So my question to you is, Sunil, if there is a PSU fund available, why should an investor not take a PSU fund?
The PSU funds journey, if you understand, and if you've done rolling returns analysis from 2009 to now, the average return in a PSU fund, the BSE PSU index, is only 4.5%. So it's neither here nor there. So basically, PSU became a theme or a flavor of the season last year only. So it was like investing in international equity after looking at the past performance of the last 5 years, 10 years, etc. in the US markets, China market, etc. And then burning your fingers. It is better let the fund managers decide whether they wish to be in those PSU stocks within those flexi caps or the multi-cap space, or even the large cap space if they wish to be there. If you try to get into a thematic sectors like this, a PSU fund, infrastructure fund, tech funds, etc., etc., somewhere down the line, you will have a very miserable journey. First and foremost, you will not understand why it is underperforming. So for the last 8-10 years, if it has not delivered returns, naturally you would have been frustrated. You would have exited out of it last year or year before last. And then all of a sudden the rally has happened. How long will that continue? Even if it continues, why can't it be done through a multi-asset, multi-cap or a flexi-cap fund where the fund managers will decide the allocation? We have done a show on Prashant Jain and his favorite PSU funds also. he had conviction, he stuck by that conviction, and all his funds have started doing well. So either you believe in those convictions of the fund managers and you wish to be in those schemes, is your call to get into those PSU stocks or not.
Okay, so Sunil is kind of saying that, hey, let the fund manager decide, and if PSUs are a hot theme, then a good fund manager will pick up on that theme and include some of those stocks in the portfolio. So don't take an added risk of taking a thematic fund like PSU funds. Actually, I think your view is probably true for, you're probably saying this for a bunch of thematic funds and not just PSUs, Sunil.
Absolutely.
Okay, great. Amol, is your answer different?
I'm afraid, it will be more of the same. See, the simple reason is, and let me go completely in a different direction. 2016 to 2020, roughly 3.5-4 years period, just before the COVID kicked in, you have pharma and FMCG to be called as one of the most defensive sectors. Now, this was the time when market was going up nifty, the large cap segment was going up, but you had 3.5-4 years underperformance in pharma. What stops PSU from underperforming? And Sunil is absolutely right here. A 10-year return, he has already mentioned rolling returns. So let me mention point-to-point return. PSU funds have underperformed Nifty on a 5-year, 10-year basis. Now, all of us on this show and people who are listening, probably informed investors, all of us invest equity for longer investment horizons. So even if even on a 5-year, 10-year journey, if a particular set of stocks or theme has not performed, then I do not understand why should I get swayed with a small 1 year, 1.5 year kind of a window and go get attracted towards those, that set of, there is also that set of stocks or PSU theme. So I would say there is no need to kind of jumping the bandwagon purely looking at the past returns. And like Sunil mentioned, all the stocks in PSU basket can as such be purchased by a fund manager if the fund manager sees conviction, if the fund manager's research, the research team's research says that the PSUs will have a good time going ahead, then anyway you will get that exposure in any diversified fund, including pure large cap, pure mid cap, small cap, or even a flexi cap, multi cap product basket.
Sunil, just one quick follow up. You mentioned Prashant Jain's funds. Are there other funds in the current scenario which are taking a bet on some of the PSU stocks more aggressively than the rest? Because, for example, ICICI as a house has been talking about PSU stocks now for a while.
I was going to say that only.
Exposure.
I think the only name I could think of was the ICICI mutual fund and some of their schemes. So specifically, I would not remember which schemes or which fund manager has taken more bets on PSUs.
So here's the deal. Maybe both our experts believe that it might not be a great idea to take thematics in general and PSUs in particular. If you still believe PSUs have a good run and you want to play it by the mutual fund route, maybe try and look at the funds which either Prashant Jain used to manage, and if some of those might still have larger PSU presence even now, or ICICI as a house. And I believe by virtue of the conversations that I've had with Naren and then some of the others, that there might still be a significant PSU presence in some of those funds. And maybe if you are so convinced, then maybe that's a way. But at large, both our experts believe that that's not a good way to go about doing it. Leave it to the discretion of the fund manager. My last talking point for today's show, and that is how should a high risk investor or an investor who is willing to take high risks design a model portfolio of sorts for the next 5 years. Now, Amol, I'll start this with you. A few assumptions here that the investor is okay taking the high risk. The investor has average income which she or he can step up over the course of the next 5 years. And the investor does believe in equities in general. It's not that the investor is a disbeliever. So she wants to understand from you, how does she make this portfolio?
Right. So thanks for giving this background. I would also say, Neeraj, that existing asset allocation, knowing that would also help. But let's keep that aside for a moment. I want to start.
It's a fresh investor, Amol.
All right. Okay, fine. So I want to start with the commonly, kind of common misconception. Let me call that. People say that risk and return go hand in hand, but it is not a directly proportional relationship. Higher the risk, it does not necessarily translate into higher returns. So when somebody says that I'm a high risk investor, even if you say so, and even if it kind of gets proven with the kind of risk appetite analysis that typically we would do for our investors, even when we do that, we would also look at the market valuations. During the opening statement of the show, Neeraj, you mentioned that Indian markets Nifty currently is one of the costly markets in terms of the valuations, even if when you look at the Asian markets as well as global markets. So now that aspect we cannot ignore. This is not, we are not betting on one particular stock. If it does well, then our fortunes will change. Mutual fund is a diversified instrument where anywhere between 30 to 50, 60 stocks would be there, and valuations would play a big role. Coming back to answering the question in a pinpoint way, I would take the thread out of my previous answer. The equity allocation today can be roughly about 60% into large cap, flexi cap, and a remaining 40 to 50% into mid and small caps. But within that, even if you're an aggressive investor, at today's juncture, I would slightly tweak that asset allocation also. So I would slightly tweak maybe 20 to 25%. I can probably park into a debt fund, or I can probably park into a balanced advantage fund, where I'm not completely exposing myself to the market, to any potential volatility of the market. But if it were to come, then I have that nice chunk of 1/5 or 1/4 of the portfolio entering at a lower valuation if the opportunity were to arise. I do not think that going 20-25% into balanced advantage would significantly alter my return profile 5 years later, even if there is no significant dip for next 5 years, which in itself is unlikely, but you get the point.
Okay, so out of 100%, 25% is into BAVs, and out of the remaining 75%, which is into equities, 60% of that is into large cap and flexi caps, and others are into mid and small caps.
And mid and small caps. Yes, Neeraj, that's correct. That's how I would currently design this aggressive high-risk portfolio given the current state of Indian market valuations.
Fair point. And because it's an aggressive high-risk portfolio, you're not including debt funds.
I'm not including debt funds. Yes, you have all. Not just have you given me the aggressive risk profile, but 5-year investment horizon is also there. And I tend to believe that over a 5-year, equity would do better than the debt on a post-tax basis.
Perfect. Thanks a lot for that, Amol. Sunil, how would you design this?
First and foremost, my biggest disconnect with the mutual fund industry is when we are bracketing investors as aggressive and conservative. Because you and I know that the most aggressive becomes the most conservative when the markets go against them. So there is nothing like aggressive investor or a conservative investor, according to me. Either he's a rational investor or he's an irrational investor. When I say
Sunil,
rational investor,
Sunil, sorry, let me define this so that it becomes easy, right? This investor, there are some investors who are happy with a high single-digit return and don't want to take that excessive risk in order to make a higher double-digit return. And I'm talking about from a perspective of an investor who doesn't mind taking a bit of a risk in order to ensure that she is not trapped in the, she's not in the bracket which is earning a higher single-digit return. She's willing to take that additional risk so that she gets a higher double-digit return.
So let the investor answer these two questions, which I have to post to them. Is first and foremost, when the markets were at high valuation and they invested in mid cap and small cap in 2018-19, and when the markets collapsed in March 2020, did you exit out of markets or did you invest more into the markets? When you invested more into the markets, then I would assume that you are a risk taker and you don't mind taking that additional risk, and you don't mind seeing your portfolios bleed. It's like Mark Zuckerberg saying, $140 billion coming down to 40 billion. He's a high risk taker, entrepreneur, or an investor. But I don't think investors in general have that appetite to stomach such kind of volatility. So what I'm trying to say is that we should be bracketing our investment strategy as aggressive or conservative based on market valuation, the way Amol just mentioned. And that's where I believe that money should be. If the algorithm of mine is saying 50% equity, and 50% debt, yes, 50% should go into equity, large, mid cap, etc. is your choice. And 50% can be your what we call value STP. You start doing STP. If the markets are in the yellow zone, step up your STP. If the markets are in the green zone, bring everything back into equity from liquid funds or debt funds. That's the way I would position a portfolio for an investor. But to make him say that I'm an aggressive investor, I don't mind going all out into equity at any valuations, even into small caps, that would be misleading the investor.
Okay, Sunil, so final question to you. So you posed the question to the investor. I'm saying that she's saying that she's been doing an SIP, and through the fall that happened in COVID, her SIPs were on. So that's the nature of this investor. at the current juncture, should she stick to 50% equity and 50% debt as you mentioned, or should she do it differently? How would you design the portfolio for such an
perfect.
investor?
So, if that person has actually stuck around during that March 2020 correction and maybe
Yes.
stepped up the investments, then I think he or she is a very rational investor. And that's where I want to differentiate between a rational investor and an irrational investor. So if you're a rational investor, you don't mind stomaching the volatility and stepping up the investments as and when the opportunity arises, then this 50-50 kind of a portfolio with 50% getting switched into equity as an STP or a value STP or whatever you want to call it is the right way of going about it.
Fair call. Okay, gentlemen, thank you so much for your time and your advice. Much appreciate and have a great remainder of the week as well. But really take a moment to appreciate your time for joining us on the Mutual Fund Show this week.
Thank you so much.
Always a pleasure to be on the show, Neeraj. Thank you.
Thank you. And viewers, thanks for tuning into yet another episode of the Mutual Fund Show.